Top entrepreneurs across the world have realized that the quickest way to grow their business is to increase their enterprise value by using OPM, other people's money. And the quickest path to growth is to find an investor or group of investors who believe in you and want to invest their resources into your vision. It is very frustrating to have a good business idea or a promising business, but you just can't have enough capital to kickstart your idea or to grow it. Well, I've been there, and yes, it is very frustrating, especially you know you can do it. But you just need some helps in terms of capital. According to research, the biggest frustrations and challenges entrepreneurs face with funding is who to ask for the money, 65%, how to ask for funding, 25%, and the balance 10%. That is the reason why I have this webinar, to show you where to find the money and what type of funding options are available. But first, you may be wondering why it is so important to raise capital for a business. It is because success or failure to raise capital can make or break your business. With extra cash, you can hire people to help you grow your business and do the work either you don't have expertise or don't enjoy doing. Also, with enough cash flow, you could grow faster than your competitors. That is very important, because in business, cash is king. With extra cash flow, you could start a marketing campaign to boost up your sales and pay better salary to attract talents. As people say, if you pay peanuts, you get monkeys. So pay well, get good talents, and it could help you achieve your vision a lot faster. So, you know the importance of outside money for business, but the big question is where to find the money. Who to ask for funding. This is the main topic I like to discuss here in this webinar. In fact,
there are many options out there, but you need to find the right fit. Because if not, you could waste a lot of precious time and effort chasing the wrong investor, and at the end of it, get nothing.
It's also one of the major reasons why many entrepreneurs fail to raise money. For the entrepreneur or business owner seeking to raise fund, there are three main types of capital to draw from. First, the equity capital. It is the term used to describe the capital that is given to a company in return for a portion of that company's stock or equity. Second, debt capital or loan. It is used when companies have a strong cash flow and can support repayment schedules. Then there is a hybrid of debt and equity known as a convertible note. Convertible notes are loans which are made to a company at a fixed rate of interest, which can either be redeemed for cash or can be converted into equity.
This way, if the business succeeds, the investor can opt to convert the note into equity and earn a higher return on their investment. But, on the other hand, if the business doesn't perform as expected, you have to pay back all the debt, plus interest. For example, preference shares. Preference shares are actually an equity stake that an investor gets in exchange for their investment in a business. However, unlike ordinary equity, which only shares certain percent of the company's profits, as dividends, investors with preferred equity are entitled to a fixed and mandatory dividend, like an interest on a loan, either on a cumulative or non-cumulative basis. No matter what funding options you use, they usually fall into one of the above.
Funding options. As you can see from here, from the initial concept all the way to IPO, most companies can source capital from a range of funding options, it actually depending on what stages of business you are in. The general rule is that the more advanced stage of your business, there's more funding options for you. And it is also easier for you to get funded. It is because the business perceived to be less risky. Normally, businesses start from idea stage or pre-seed stage. There is no business yet, all you have is a bright idea and maybe one or two co-founders. Then you raise some pre-seed money to create a prototype or MVP, and then sold it to one or more users. The purpose is to validate your product. If you manage to sell your products to someone else, it shows that there is a demand for your product. If you manage to do so, the next step is to raise some seed money to go live. Get an office, get some staffs, do more marketing, etc. The purpose is to get more tractions and prove that it is commercially viable. Once you are able to prove that your product is commercially viable, with repeating sales, more clients and more tractions, you then go for series funding. Series A, Series B and so on, to grow your business even further and replicate its success on a larger scale, until exit via trade sale or IPO.
Okay. Now that you've seen a brief overview of what's available, let's talk about the process of growing a business by utilizing outside investment in more detail. As the business becomes increasingly mature, it tends to advance through the funding rounds. It's common for a company to begin with a pre-seed or seed round and continue with Series A, B, and then C, D funding rounds, then mezzanine and IPO. In the following slides, we'll take a closer look at what these funding rounds are, how they work, and what sets them apart from one another. For your info, the path for each startup is somewhat different, as is the timeline for funding. Many businesses spend months, or even years in search of funding, while others, particularly those with ideas seen as truly revolutionary, or those attached to individuals with a proven track record of success, may bypass some of the rounds of funding and move through the process of building capital more quickly.
At this stage, there is no business yet. All you have is a bright idea and maybe one or two co-founders. Pre-seed startups tend to be associated with the early prototype stage, prior to launch. Pre-seed funding range from $5,000 to $100,000, but not all business raise a pre-seed round. Some may just go direct to seed or series A round if the business is, for example, already have users base or is generating revenue. Most pre-seed startups funded via founders' own funds, and the triple F methods: friends, family and fans. The startup is not ready for more sophisticated investors such as angel investors or VCs yet. Instead, you should be looking for co-founders, partners, and people who can roll up their sleeves and help build and validate your product. Donation or rewards-based crowdfunding or accelerator and incubators will have some of the best solutions for you at this stage. With this funding, the company often perfects its business plan and starts building its founding team in order to position itself for its next round of funding. Depending on your unique situation, the money could be used for: cover the most basic expenses, like company incorporation, a website, office rental. Hire a founding team, develop product, test the concept and go to market, or just simply explore the idea. As I mentioned earlier, the most important objective at this funding stage is to validate your product, i.e. to prove that there is a demand for your product, people are willing to pay for it. This is partial list of accelerators and incubators in Malaysia and Singapore. It can be government-sponsored, corporate or private. They usually nurture, mentor, fund and develop startup businesses. Accelerators focus on startup businesses, incubators focus on idea stage businesses. Accelerator and incubator programs usually last weeks or months, and most are opening up across the world. Seed funding or seed capital refers to the first official money that a business venture or enterprise raises. A seed round is often used to cover expenses and gain tractions until a startup can start earning revenue, or have repeating sales. At this stage, the startup is likely to have validated its market with some customers or early users. Here, founders are selling their vision, prototype and a good team. Seed funding typically ranges from $100K to $2 million, but this amount can be much higher on a case-to-case basis. Most companies raising seed funding are valued at somehow between $3 million and $6 million. Who invest? Startup accelerator, angel investors or angel groups. Some government program, and even the rare early-stage VC firms, and they are typically structured as convertible notes or preference shares. Some may opt for the crowdfunding path. It could be equity or rewards-based or ICO or combinations. Seed fund helps a company to go live with the business or to scale their initial sales and marketing, or to hire some employees and find product market fit. The most important mission at this stage is to get tractions.
Crowdfunding has become one of the most popular ways for individuals to raise money. As you can see here, there are different types of crowdfunding for different purposes. For example, equity or rewards-based donation, for real estate only, lending or P2P crowdfunding, Sharia-compliant crowdfunding platform for social causes, or even cryptocurrency crowdfunding. You have plenty of choice here. Also, most governments in the world develop programs and allocate funds in their annual budgets to support startups and SMEs in their country. There is no difference in Malaysia. Here, we have government agencies such as Cradle, MOSTI, MTDC, SME Bank, SME Corp etc. to provide guidance and financial support. The purpose is to create more jobs, help in economic growth and of course, increase tax revenue. If you think you might want to work with an angel investor, the first step is to find one. There are many regional-based angel network you can approach, for example, Business Angel Network Southeast Asia, Singapore Angel Investment Network, Malaysian Business Angel Network etc. They are all welcome entrepreneurs and good investment opportunities in this region.
Once a startup makes it through the seed stage and they have some kind of traction, number of users, revenue, views or whatever key performance indicator they've set themselves, they are ready to raise Series A round to help lift them up to the next level. When a startup has achieved considerable traction, it usually has a substantial number of clients that proves its product or service is commercially viable to move to the next milestone. Growth. Because the investment is higher than the seed round, usually 2 million to 5 million. Investors are going to want more substance than they required for the seed round before they commit. It's no longer acceptable to have a great idea, the founder has to be able to prove that the great idea will make a great company. The typical valuation for a company raising a seed round is 10 million to 15 million. Who invest? Series A rounds, and all subsequent rounds, are usually led by one investor, who anchors the round. Getting that first investor is essential, as founders will often find that other investors will fall into line once the first one has committed. Series A funding may also comes from venture capital firms specializing in early-stage investment. Equity crowdfunding, initial coin offerings or initial exchange offering can be an option too. Use of money at this round is usually for hiring new employees, acquiring new customers, generate more sales, building organizational infrastructure etc. The main objective is to grow your business as fast as possible. The money usually enough for 6 months to 2 years of operations, call, runway, to reach its next milestone to raise the follow-on round of funding. Series B is the round that follows Series A in early stage financing. At this stage, the startups would have figured out its product market fit and user base and a business model that will generate long-term profit. It also signifies the move from startup to scale-up with consistent revenue growth. The big question here is, can you make this company that you've created work at scale? Can you go from 100 users to 1,000 users? Or even million users? A Series B round is usually between $5 million and $10 million. Companies can expect a valuation between 30 million and 60 million. Series B funding usually comes from venture capital firms, often the same investors who led the previous round. Because each round comes with a new valuation for the startup, previous investors often choose to reinvest in order to ensure that their piece of the pie is still significant. Companies at this stage may also attract the interest of VC firms that invest in late-stage startups. Other options could be bank loan, P2P lending platform, ICO, IEO or STO, security token offerings if the company plan to tap into crypto funds. Most of the funds raised from the Series B round is used to increase market awareness through advertising, business development, and sales efforts. The purpose is to increase market shares and to make competitors give up. The funds are also used to strengthen the operational capacity of the business by scaling up manufacturing, increase inventory and hiring talented people to support critical functions of the business.
In Asia, venture capital investments reached an annual high of over $90 billion in 2020. The VCs are very active across Singapore, Southeast Asia, and Asia.
Companies that make it to the Series C stage of funding are doing very well and are ready to expand to new markets, acquire other businesses, or develop new products. Series C is often the last round that a company raises, although some do go on to raise Series D, E and beyond. However, it's more common that a Series C round is the final push to prepare a company for its IPO or an acquisition. For this round, startups typically raise an average of 25 million. Valuation of Series C companies often falls between 100 million and 120 million, although it's possible for companies to be worth much more, especially with the recent explosion of unicorn startups. Once a company has built a product that's become a leader in the market, that's when the private equity and investment bankers show up. Those people are not looking for a lot of risk, they let the angel investors and venture capital firms deal with that. They are looking to put massive sums of money into a company that are already winning to allow them to secure their leadership position. Other funding options could be the conventional bank loan or crypto funds. Generally, Series C companies are looking to take their product out of their home country and expanding into international market. They may also be looking to increase their valuation before going for an initial public offering or an acquisition.
Here's a list of top private equity firms in Singapore. All of them have a really deep pocket, and is usually invest 100 million or more in a single company.
As conclusion, raising money is challenging, but you can do it. Because there are literally millions of investors out there looking for talented entrepreneur like you to work with. The big question is, are you good enough?